In world history, no one has been wealthier than Americans. However, a lot of people are worried about their finances. Even if their earnings are relatively substantial, are they living over their means? Are they living paycheck to paycheck and maxing up their credit cards? Are they putting money away for unforeseen costs? Can you maintain financial security even if you don't earn much money? Can regular people invest in stocks with acceptable risk? The answers to these questions serve as a first checkpoint on a checklist for financial literacy. There are several categories covered while discussing the checklist of concepts one must comprehend in order to be labeled financially educated. These pertain to your regular financial life in general, the fundamentals of debt, and an understanding what credit card debt, mortgage debt, and auto payments entail. It also pertains to budgeting and knowing how much money comes in and goes out. It's things that, although sometimes may appear quite straightforward, is obviously not. You must worry about your expenditures if you lack financial literacy. When you retire, you must worry about whether you can achieve your objectives. Money is the beginning of it all. Income simply refers to your incoming funds. How do you generate income? When choosing a career, the law of comparative advantage is helpful. Find out what you excel at and enjoy doing that other people value highly. I put a lot of effort into starting a successful business, so I no longer have to worry about things like monthly expenses and other such things in my life, but only because I used to worry a lot. I lacked financial support from my parents. Nothing was there for me to fall back on. There was no security net. But I did meticulous planning, set goals, and then tried to work toward accomplishing them. To think in this way, you don't need to run your own company. Consider how you may increase your value to current and potential employers, coworkers, and clients. Even if it's a minimum wage employment, an internship, or volunteer work, how can you improve what you're doing now? Being the first to arrive, the last to depart, and refraining from texting while working all indicate that you are working harder than others. These kinds of decisions set you apart from the competition and add value to you in the employment market. Keep in mind that in the real world, you get compensated for your value creation rather than your effort. Furthermore, managing that money is just as crucial as obtaining it. Money is spent on expenses. How do you choose to spend the money you have made? Are you even aware of where your money goes? Numerous people don't. If there was one financial literacy skill I could impart to young people today, it would be how to create your own financial budget and how to carry it through. All I'm trying to convey here is the idea that some expenses are constant. Their income is $3,000, but their costs are $2,500. They require your fixed expenses like your rent, car payment, and other necessary costs. That figure must be less than what is going in. The 50-30-20 guideline, which states that 50% of your monthly income should go toward housing and bills, is, in my opinion, the most straightforward approach. The remaining 20% is allocated to amusement or going out for activities you enjoy doing, while 30% is allocated to finances, which includes saving or paying off debt. Therefore, it stands to reason that the broken items must be taken care of first, adding percentages to the remaining amounts. I believe that happens far less often than it should. When one doesn't do it, there are a few things that might go wrong. This is, of course, very typical. You wind up living your life where you're constantly playing catch up, and it can be very crippling when one falls behind. Then a new paycheck and bonus arrive, but they are unable to enjoy the benefits since they are still reimbursing themselves for the previous toy they had bought. Thus, you live at the rear rather than the front. I believe that not only negatively affects a person's ability to enjoy life, but also their degree of stress. If people just began putting their financial priorities into their monthly cash flow planning, I believe that would be a huge first step toward financial literacy. Things you own are assets. Everything from a house to an automobile to your bank account. Saving is a first step on the path to acquiring assets. The strongest justification I can provide for why even a high school student with a part-time job should start saving in some capacity is that it becomes a habit. I think there is much to be said for simply starting the practice of setting aside $5 or $10 per week or any other amount. For unexpected expenses, save frequently. You are aware that you might become sick, your phone might get stolen, and your car will need to be fixed. I like to open a savings account to keep that money out of sight because if I see it, I'll spend it. In order to pay for my automobile insurance at the end of the year, I deduct a set amount from each paycheck, which is then automatically sent to a savings account. If you want your paycheck to be deposited into your account and then automatically transferred to your savings account, you should set up your bank account to do so. Your funds become a fixed expense. Your checking account must be used as the source of payment. Your first payment is to yourself. When that's done, a variety of options are then available to create new investing accounts. You'll be able to live a life with less financial stress and worry if you adopt this strategy. You'll be able to steer clear of financial mistakes and problems. Make sure to diversify your investments as you accumulate savings. Always keep in mind not to put all of your eggs in one basket because, well, you get the picture if that one basket were to fall. When you buy a stock on the market, you are investing in a small portion of the firm. As a result, you acquire a stake in the company and turn into an owner. Additionally, it rights you to a portion of the company's future revenues that it hopes to make. The possibility that the business will fail makes it risky. Therefore, investing in the stock market offers an appropriate balance of risk and reward for financing American businesses. The easiest option for someone to participate in the stock market with a small amount is by purchasing an index fund, an ETF, or a mutual fund since they are gaining broad exposure to many different firms rather than simply buying one stake. What's with all the talk of mutual funds and index funds? A mutual fund is a professionally managed investment portfolio that gathers money from many types of investors, including you, who are wanting to diversify their holdings. The simplest approach to make sure you aren't placing all of your eggs in one basket is to do this. The only difference between index funds and exchange-traded funds, or ETFs, is that index funds and ETFs are managed to track the performance of a certain group of firms, such as a group of tech companies or a group of consumer goods companies. I want to own Apple and I want to own Nike, but instead of choosing individual stocks, people might decide to invest in an index that consists of a large group of these businesses. There are numerous different indexes and index funds available. The S&P 500, which essentially represents 500 of the largest publicly traded American companies, may be the most popular. With diversity, you may rest easy knowing that even when the value of one asset declines, others are probably going to rise. However, they want to be certain that the money they invest will have a long-term use. Over time, the stock market has produced extremely strong returns, but there are also times when it may be quite volatile. Because of this, someone with financial literacy should hopefully be able to understand which instruments are best for short-term goals, intermediate goals, and long-term goals. Compound interest is a potent weapon in your approach. The most potent force in the cosmos, according to Albert Einstein, is compound interest. The greatest approach to benefit from it is to begin carefully investing once you have a real-world savings account set up and saving money while still young. It will add up to hundreds of thousands of dollars after 20 to 30 years of compounding. I'm saying that for typical middle-class families, the difference between starting to save at age 50 and starting to save at age 25 might be hundreds of thousands of dollars, and that's just because time works in their favor over a longer period of time. Diversified stock holdings have produced a real rate of return of roughly 7% despite all previous and historical recessions and booms. It's crucial to consider the rate of return. An asset yielding 3% will double in value every year for 23 years, but an asset producing 7% will double in value every 10 years. Everyone has opportunities when investing in the stock market. When you put time on your side, you can really take advantage of the time value of money, and that makes a huge difference. The temporal value of money gives them a tremendous advantage when it comes to that contribution to themselves. Additionally, there are calculators available for use, but individuals never trust the results. Simple interest would simplify a function as follows. You start with $100, earn 5%, then you'll make another 5% on that $100 to make $105. This means that 5% is just being added to your initial $100. You currently have $110. $115 the following year, and $120 the following year. Compounding means that your $100 turns into $105 the first year. However, 5% is then added to that amount, $105, and if we add another number, $111, it is then applied to that. The numbers begin to deviate from the money's initial denominator as a result. Because of this, mathematically speaking, compounding has a really particular force. When people don't comprehend the temporal worth of money, I believe there is really no such thing as financial literacy. Debts that owe you are liabilities. You can also run afoul of the time worth of money. Many people fall into financial difficulties because they consistently spend more money than they make. Credit is widely accessible right now. Both good and bad come from that. Credit can improve your capacity to make alluring investments like a home or a college education, therefore it's beneficial. In my opinion, there is a significant distinction between using credit to purchase an asset and using credit to pay for a purchase. Okay, so if you go to a pizza restaurant with your pals and spend money you don't have, the pizza is actually gone and you can't get it back. When you purchase a home, you borrow money, but you are also purchasing an asset that has some residual value. Assuming that the cost of servicing the debt and paying the borrower back with interest is manageable, this allows you to purchase a very expensive asset before having to save up the full cost. The ability to make a very selfless effort to save the down payment and take on an amount of debt whose service may even be less than they are paying in rent already, or perhaps even equal to it, then they are developing equity. The second example has always been student debt, which you incur, must repay, but at least you are building an investment into a profession into the future to educate. Borrowing, however, can be detrimental if you use it to pay for items that will quickly lose their value, travel on spring break with student loans, or just max out credit cards to pay the minimum balance. Your financial worry will increase if you carelessly spend more money than you make, as your wealth will decrease and you'll have to pay a lot in interest on things you've already used up. Generally speaking, when using credit to pay for travel expenses, surfboards, clothing, and nights out with friends, the asset has been lost. You have no assets, but you still owe money. By doing so, all you're accomplishing is making yourself poorer. One of the greatest gifts a young person can ever offer themselves is arguably the early avoidance of credit card debt. When you're attempting to advance in your adult life and have considerable credit card debt, it can be really crippling to have to pay it off. Because of the stress and concern over your interest rates increasing as a result of not being able to pay off those cards each month, you'll become much less financially secure. Someone can reach a point where they are actually spending more than $1,000 per month and making no progress toward paying off their debt. And that, in my opinion, is what actually transpires. You grow acclimated to the idea that I have a set expense of just making a credit card payment. I recently made a monthly credit card payment of $700, and that may make up a significant portion of one's salary. In the end, it causes a feeling of frustration as though one can never advance. You receive a raise, but you are unable to save or invest any of the additional funds since you are still falling behind and trying to catch up. The worst effects of having too much debt have always been psychological. People's joy is sapped by them. They diminish hope but increase their fear. They diminish your sense of hope for the future. The money you make is therefore your income. Make the most of your earning potential. To accumulate assets, things you own, save. Create a financial strategy and keep your responsibilities and expenses to those things that will grow your assets or your potential to make money. Most people don't need an education to know how to purchase more pizza or go out with their friends more, but learning how to save money, create goals, budget, and do other similar things effectively requires education, sacrifice, and character attributes. The primary reason why individuals don't understand the financial market, plans, saving, budgets, or any of the other topics we covered today is, in my opinion, that they are frightened they won't understand it or seem foolish if they do. Simply avoid discussing it altogether. The worst thing you could do, in my opinion, is that. The more you discuss something, the more clearly you comprehend it. The more you know and the more you can impart. Following strong concepts and growing them as a way of life, a manner of living, is the key to successful personal finance. Even with low income, you can feel secure financially. However, it will demand both preparation and dedication. Create your strategy now and make the commitment to stick with it. You'll be grateful to yourself later. Thanks for watching, and don't forget to like, subscribe, and hit the bell to get notified of future videos.